All right, let's get down to business. Dow Industrials today up 143 at 11,153. The S&P 500 up 9 at 1,160. NASDAQ Composite down 10 at 2,480. Yield on the 10-year note, 1.95%. Oil up 84 cents at 82.98. Quiet day for gold and silver. More on that in a moment. Once again, Wall Street started the day with optimism and enthusiasm. The Dow Industrials jumped about 260 points this morning. Then the index slipped into negative territory. Then it rallied into the close. Go figure. German Parliament approved a revamped Euro bailout fund. Under the plan, the EFSF will be enlarged to $480 billion, and the actual price tag is going to be much higher. It'll also be given the ability to give precautionary loans to struggling European countries, buy EU government debt, provide funding to shore up the capital reserves of European banks, the same banks that were 100% capitalized last week. 7 more Euro countries still have to vote on that bailout. The voting won't finish until the end of October. For things to improve, a whole host of things need to go right, but even a single misstep could worsen the crisis even more. New Bloomberg survey shows 93% of investors think Greece will eventually default. It's widely accepted that the EFSF will be inadequate and will require radical enhancement virtually as soon as it's approved. Last weekend, Treasury Secretary Geithner demanded a huge increase in the $440 billion bailout fund. So, very soon we're starting to hear about expanding the guarantees, expanding the insurance that the EFSF will offer for creditor countries, maybe even talking about a EMF, a European version of the International Monetary Fund. Everybody in German politics knows the current mechanisms are worse than useless if, for example, Spain or Italy goes down the path of default. Right now we're not there. Italy held a bond auction this morning. They sold about $7 billion, or rather 7 billion euro worth of 10-year bonds. The yield or interest rate hit 5.86%, up from 5.22%. It's the highest rate for Italian 10-year bonds since the euro was introduced. Very pricey, but not outrageous. The crisis has been contained, at least for today. The euro moved higher against the dollar. Labor Department reports first-time weekly unemployment filings dropped below 400,000 for the first time since August, falling by 37,000 to a seasonally adjusted 391,000. That's nice, but 1 week does not make a trend. Next Friday, we get the monthly jobs report for September, and it will likely show the labor market remains sluggish, unemployment probably still right around 9.1%. Federal Reserve Chairman Ben Bernanke delivered a speech last night in Ohio at a forum sponsored by the Cleveland Fed. It was the first time Bernanke has talked publicly since the FOMC meeting and the launch of Operation Twist. Bernanke stated with unusual bluntness that Operation Twist has no chance of helping revive the economy, and he admitted the Fed has run out of bullets. No, not really. I just wanted to make sure you're still paying attention here. Bernanke did say that long-term unemployment is an American national crisis. He suggested that Congress should take further action to combat it. Bernanke noted that about 45% of the unemployed have been out of work for at least 6 months. This is unheard of, he said. There was a question and answer session after the official speech, and this was part of the Q&A afterwards. He said, "This is unheard of. This has never happened in the post-war period in the United States. They are losing the skills they had. They are losing their connections, their attachment to the labor force." And he added, "The unemployment situation we have, the job situation, is really a national crisis." Bernanke says the government needs to provide support to help the long-term unemployed retrain for jobs and find work, and he suggested that Congress should take more responsibility. And Bernanke then gave a hint that the economy might need more, what can we call it? Might need more juice, might need another jolt, a shot in the arm, monetary encouragement, a boost, a bang. No, we can't call it QE3. We can't call it stimulus. But Helicopter Ben seemed to indicate he's not afraid to crank up the printing press, saying, if inflation falls too low, or inflation expectations fall too low, that would be something we have to respond to because we do not want deflation. He also said lawmakers should provide more help to the battered housing industry. Bernanke said some strong housing policies to help the housing market recovery would clearly be very useful and would allow the monetary policy actions of the Fed to have more effect and to help the economy recover more strongly. And then Bernanke finished his speech by saying, really, we're completely out of bullets. Gross domestic product, broadest measure of the nation's economy, grew at a 1.3% rate in the 3 months ending in June. That is an improvement from the 1% growth rate that was the previous estimate from a month ago. Commerce Department makes a couple of guesses on GDP, and then they issue their final guess, and that's what they did today, 1.3%. Much of the improvement, they say, was due to a higher estimate on what consumers spent during the quarter. Still, it's not considered to be strong enough growth to change the unemployment problem, not enough to avoid another downturn in the economy. Economists at Citigroup have again cut their global gross domestic product forecast for 2011 and 2012. They cut their estimates less than a month ago, about 3 weeks ago. This time they're saying growth prospects continue to deteriorate quickly. At a global level, the bank's Citi Investment Research and Analysis Unit now predicts growth will slow to 3% this year, 2.9% in 2012. 2% global growth is seen by the IMF and the World Bank as the classification for global recession. Citi downgraded its outlook for the United States, Europe, Japan, Canada, and the UK individually. Further, Citi researchers expect more sovereign ratings downgrades among the euro area countries over the next 3 to 6 months, including Italy, Spain, Greece, Portugal, and Cyprus. Analysts at Goldman Sachs are warning of the risk of a great stagnation. The Goldman report says during these episodes, GDP per capita growth hovers below 1% and is less volatile than usual. They are also characterized by low inflation, rising and sticky unemployment, stagnant home prices, and lower stock returns. Stagnations are more likely than you would like. Because these events are correlated with financial crises, the conditional probability of stagnation in the current environment is higher than normal. And they went on to say trends in Europe and the U.S. are so far still following growth paths typical of stagnations. So it's not a recession, it's not a depression, it's a great stagnation. The Goldman report predicts a 40% chance of stagnation in the world's developed markets. In order to avoid such an outcome, they say it would require governmental policy that restores confidence and growth. Here's the quote. Whether these countries manage to avoid a great stagnation by a pickup in the recovery is likely to depend upon policy being able to restore confidence and putting in place reforms that can decisively jolt growth. End quote. What's another word to describe a jolt to the economy? You juice the economy, a shot in the arm. Dare we say stimulus? Yeah, that's it. Stimulus. And what's another word for stimulus? Free money. That's the answer. If you want to avoid the great stagnation, The government needs to crank up the printing press and hand out free money to Goldman Sachs. I used to think this macroeconomic analysis was difficult and complex, but really, it's pretty simple. Crank up the printing press, pass out some free money to the banks. It's not that difficult. Hey, if you think that there might be problems over in Europe, if you think that there might be problems with cranking up printing presses at some point, then you need